If you have been trading volatility indices and it feels like the market is just moving randomly, you're not alone. But here's the truth. Once you understand how to use TradingView properly, this market becomes a lot more predictable. In this video, I will show you a 3 simple step framework that you can start using immediately, even if you're a complete beginner. By the end of this video, you will know how to set up volatility indices on TradingView, how to identify trend, and exactly how to enter your trades with confidence. First, let's get this out of the way. Volatility indices are synthetic markets, so now you can find them on TradingView. Before, you could not find them on TradingView like the normal forex pairs. The only broker that actually offers volatility indices is the derivative broker. You'll find the link in the description of this video. What matters is not the broker, it's your ability to read price very well. So without wasting much of your time, guys, let's dive straight into it. Before you even think about entering a trade, you need to answer one question. Is the market going up or down, or is it ranging? Here's how to actually identify and keep it simple. For an uptrend, you have a high, you have a low, you have a high, you have a high low, a high and a higher low, and a high and a higher low. Meanwhile, on a downtrend, you have a lower low and a lower high, a lower low and a lower high, a lower low and a lower high, a lower low and a lower high. So when you identify these structures, or you are actually identified the trend of the market. So for this particular scenario, if you are seeing higher highs and higher lows, that means it's a bullish market. And if you are seeing lower lows and lower highs, that means it's a bearish market. On the other hand, if the market is actually ranging, that means it's actually trading sideways between two key levels, where one side the high and the low. So in this particular case, you want to be actually avoiding that. You don't want to be in this kind of market. Okay, so now let's look at my major trading strategy. Okay, the particular type of structure I use. Okay, the market structure I use. Basically, I trade the advanced market structure. So this is the advanced market structure. So for the advanced market structure, guys, we are actually dealing with liquidity sweep and a breakup structure. So the market must always grab liquidity before it moves to any given direction. Okay, so now what is a sweep of liquidity, guys? A sweep of liquidity is actually when the market actually sweeps a particular high. Let's say the market is moving to the upside. Okay, a sweep happens when there's actually a break of structure to the other direction. Okay, so in this particular case, we have a sweep of liquidity right here. All right, so on the other hand, guys, you can also have a sweep of what liquidity, just like this. Okay, in this particular case, you have what a sweep of what liquidity, guys. So you have what a sweep of liquidity to the what downside. All right, so you have a sweep of liquidity. So that is how simple it is, guys. It's very, very simple. So anybody can actually do this. All right, so anybody can actually do this. All right, it's all about understanding the context. So now that we are done with that, let's look at my trading strategy. Since we have actually understood what is a break of structure, what is a sweep of liquidity, all right, the most basic and important things. All right, so now let's dive into this particular area here. So for the advanced market structure to take place, there are mainly 3 models. Okay, so and this is the number 1 model, which is the A plus what setup. Okay, for the A plus setup, we must have what a sweep of liquidity, and then we must have what a break of structure to the downside. All right, and there must be what pullback. So this pullback must at least be what up to 50%. So from the swing high to the swing low, it should be at least 50% of the Fibonacci 2. Okay, so the market has to be at least 50%, retrace back at least 50% of the Fibonacci 2, and it does that in order to create structural liquidity. And what's the structural liquidity? The structural liquidity has to be the main purpose of the structural liquidity is for it to be taken out, okay, before the market will continue to move in the particular intended direction. So now let's go through it again. For the advanced market structure to take place, there must be a sweep of liquidity, and secondly, there must be a break of structure to the opposite side, and thirdly, there must be what a pullback to provide what structural what liquidity. So when there's a pullback to provide structural liquidity, that pullback must at least be what 50 what percent. All right. So now there must be what a second break of structure which actually validates what the setup. So now what happens? You wait for the market to actually come, grab the liquidity resting above that area, which is can be your supply zone or your POI. Okay, can be your supply zone or your POI. So now when the market comes here, you look for what for confirmation to actually enter and then sell all the way to this particular area, which is your target. All right. So this area becomes your protected high, and this area becomes your protected low. So since we are done with that, now let's look at a few examples. All right, let's look at a few examples. Okay. All right, so here you can clearly see that. Let me just take this out. Okay. All right, let me just take that out. So since you can clearly see this now, let me just break it down a little bit. All right, so that you can actually see it for yourself and get to understand what I'm actually talking about. So right here, you can see that there's what a sweep of liquidity, which you can clearly see. And there's a sweep of liquidity. All right, so whenever the sweep of liquidity is more or less like a false breakout. Okay, a sweep of liquidity is more or less like what a false breakout. So we have our sweep of liquidity right there. So what are we looking for? Okay, the market created this low before actually sweeping that area right there. So this becomes our what our first break of structure. Okay, so since this is our first break of structure before the pullback, all right, we're just going to go ahead and label that to be our first break of structure. Okay, let me adjust this so that it can actually look a little bit nice. So we have our first break of structure right there. So next thing we want is a pullback, okay, to provide what structural liquidity. So to actually determine that accurately, guys, you need to pick your Fibonacci 2 from the swing high to the swing low. Okay, so it actually meets exactly with the 50%. So now that is established, we're just going to go ahead and mark that to be our structural liquidity, which is right here. Okay, all right, we extend it to the left, and then we put that to be our structural liquidity. All right, so now what happened? We have a second break of structure, which also leads to this break of structure, which makes it a more valid setup. Okay, so it breaks this structure, but the overall structure which I was actually looking at was this particular area. This is a setup that actually validates what the trade. Okay, so this is a setup that actually validates the trade. So now let's see what happens. Now before we finish, we mark out this area to be our supply zone. Okay, that's where we want to be actually entering our trade zone. And now let's mark out our protected high, which is this. All right, so that is it. Let's see what happens, guys. We want to pick out our protected low. Okay, so for our protected low, this particular area, the last low that was created before the market started pulling back. Okay, so now let's see what happens. All right, see how the market just tapped into there. What do? You sell at that particular area, and then your stop loss just slightly above that area, and your first target should be this particular area here, which gives you a 1:4, and then your second target should be here. All right, let's see if we are actually going to hit those TPs, guys. So what happened? Our first target has been met. So now let's see if the second target is actually going to be achieved. Okay, all right, so our second target has also been achieved. So two TPs are actually being achieved on this particular single trade, which is actually very simple. Now let's look at another example with the VIX 10 1 seconds. All right, so give me a moment. All right, so right here, guys, you can clearly see let me just look for that particular area where that happened. Okay, all right, so now let's just go ahead and cut this off. All right, so that we can break it down so that you guys can get to understand. Okay, it's all about understanding. So now first we have to actually identify what the trend of this market. Okay, I'm going to go to the weekly time frame. All right, so from the weekly time frame, we can see that the market has actually grabbed the liquidity resting above that area, which actually means that this particular move from here, from this origin, is actually what complete. Okay, market has actually grabbed liquidity from to that area. Now let's go to the daily time frame and see what's happening there. All right. Let's see what the daily time frame is all about. Okay, on the daily time frame we can actually still establish the same thing. Okay, we can actually still establish the same thing, that the market has actually swept that high. Okay, and now we can see that the structure of the market has actually changed. So now let's map our chart out. Okay, we have what a sweep of liquidity right here. Okay, we have our sweep of liquidity, right? This is our sweep of liquidity. All right, so the next thing we want to look out for is our break of structure. Okay, let me just make this a little bit clearer. Okay, we have our sweep of liquidity, which is right there. All right, the next thing we want to look out for is our break of structure to the downside, guys. So you can clearly see it here, and there's what a break of structure to the downside. So this break of structure led to this pullback. Okay, so now let's mark that out. We have our first break of structure, and the next rule states that we must have a pullback which is at least 50%. Okay, so let's see, from there, from the swing high to the swing low, so we have our pullback which is at least 68%. Okay, which is valid. All right, so now we mark out our structural liquidity. Okay, so this becomes what our structural liquidity. All right, I'm just going to go ahead and just label that structural liquidity. Okay, so the next thing we're going to do is to mark out our second break of structure, which is clearly here. All right, so this is our second break of structure, and then now this becomes our POI, our area of interest. Okay, so now let's see how far the market goes before turning back. Okay, so that we can actually mark out our protected high and protected low, so we can get our ABC. All right, we know the origin, okay, and then the target, right? So let's see. Okay, this becomes our new protected low. All right, let's see what happens, guys. Okay, all right, protected low. So it must be the low that leads to the structure taking out of the structural liquidity. Let's see what happens. All right, let's see what happens. Okay, the market is actually coming to our area of interest. Our area is our supply zone. Let's extend it to the left. Okay, all right, let's see. Okay, market touches our PI. I was supposed to take the trade, yeah. So the market touches our PI, and then stop loss just slightly above it, and then our target, I'm going to target this area here, or I can actually go a bit further, but let me just target here, or at least 1:5, 1:6. All right, let's see what happens, guys. Okay, clean, guys. You don't have to always be too greedy, guys. So this is it. This is how this strategy works, guys. It's very simple. All right, so for entries, guys, you don't have to do it like this. You have to redefine your entries by going to the smaller time frame to check the smaller time frame and use candlestick rejections. okay, or you can actually use a break and retest on that particular area, or strong momentum candle. Okay, so let's keep it simple. Identify the trend of the market, mark your key levels. Okay, our key levels is using the advanced market structure, where we have our sweep of liquidity, our first break of structure, a pullback to provide structural liquidity, which must be at least 50%, and the second break of structure, and lastly, market must come back to grab that structural liquidity. Let's keep it real. Most traders lose money not because the strategy is hard, or because they don't stick to it. If you can master just these 3 steps and stay disciplined, you're already ahead of most traders. And if this helped you, make sure you like the video and subscribe. And if you want, I can break down a live trade using this exact same strategy in my next video. Just drop a comment on.